What's going on YouTube? My name is Chris from Project Option, and in today's video, I'm going to explain to you call options in great detail, so be sure to stick with me. In this video, I'm going to explain to you buying call options as well as selling call options, and I'm going to do that by intuitively explaining to you how call options get their value, how each strategy works in terms of buying call options and selling call options, and I'm going to do that by showing you numerous historical trade examples so you can see exactly how buying call options and selling call options make and lose money as trading strategies. I'm also going to enter real call option trades using the tastyworks brokerage software so you can see exactly what it looks like to go through the motions and actually make a call option trade using real trading software. To first explain to you what a call option is, I'm going to explain it from the perspective of a call option buyer. In the most common explanation, a call option is described as a contract that allows the option buyer to purchase 100 shares of stock at the call option strike price at or before that option expires. In options trading, a strike price is the price at which the option can be converted into shares of stock and therefore where a transaction will take place if the option is exercised. For example, if a call option has a strike price of $105 and that call option is exercised, the call option buyer will purchase 100 shares of stock at $105 per share, which is the call option strike price. So a strike price is simply the price at which shares will be traded should the option be exercised. As an example, let's say we're looking at a call option on Apple with a strike price of $200 and an expiration date of October 2019. Let's say this option is currently trading for a price of $13.50. If a trader buys the 200 call option in Apple that expires in October 2019 and they pay $13.50 for that option, this means that the trader has the ability to buy 100 shares of Apple stock at $200 per share before the option reaches its expiration date, which in this example is 63 days away. There are two basic concepts that you need to understand here before we move forward. The first basic option concept that you need to internalize here is that options are quoted on a per share basis, and a standard option, such as an option on Apple, can be converted into 100 shares of stock. All this means is that we need to convert the option's quoted price into its actual value by multiplying the option's price by the option contract multiplier of 100. This means if a trader purchases the Apple call option for its quoted price of $13.50, that trader actually needs $1,350 to purchase that option because the option is actually worth $1,350 since we have to take its quoted price of $13.50 and multiply it by the option contract multiplier, or how many shares that option can be converted into, which is 100. So if we take $13.50 and multiply that by 100, we get the option's actual value in dollars of $1,350. As another example, if I'm looking at options on SPY and I see an option quoted at $3.16, I know that option is actually worth $316 because I have to take that quoted price of $3.16 and multiply it by the option contract multiplier of 100 to get an actual option value of $316. The second and perhaps the most critical concept that you need to understand about call options is that a call option's value is directly tied to its strike price. What I mean by that is since the call option buyer can purchase shares of stock at the call option strike price, that call option is going to become more and more valuable as the stock price increases further and further above that called strike price, because the higher the stock price gets relative to the call option strike price, the call buyer now has a bigger advantage of owning that call option, because since that call option strike price is fixed and they can purchase shares of stock at the call option strike price, that means that if the stock price continues to increase, that call option's value will also increase because that call option is literally becoming more valuable because its ability to purchase shares of stock at the call option's fixed strike price is getting more and more advantageous as the share price increases, because the call option buyer can buy the shares of stock at a deeper discount relative to the current share price. If I own an Apple call option with a strike price of $200 and Apple's share price is at $220, my 200 call option is going to be worth at least $20 or $2,000 in value when we account for the option contract multiplier, because my 200 call option can purchase 100 shares of Apple stock $20 below the current share price of $220, and that means the call option's value has to be worth at least $20, since the value in buying shares of Apple stock $20 below the current share price is worth at least $20 per share. When the stock price is above a call option strike price, the call option has intrinsic value. Intrinsic value is simply the difference between the stock price and the call option strike price. So intrinsic value can literally be interpreted as the benefit or value associated with buying shares of stock at the call option strike price, as opposed to buying shares of stock at the current share price. As another example, if Apple is trading at $235, that same 200 call option that I was discussing earlier now has $35 of intrinsic value, because with Apple stock at $235, that 200 call option can be converted into 100 shares of stock at $200 per share, which has a value of $35 at a bare minimum, since Apple's current share price is $235. In options trading, it is a law that options will be worth at least their amount of intrinsic value. Otherwise, there's an arbitrage opportunity or an opportunity to make a risk-free profit. With this in mind, how do call option buyers actually make money on a trade? The goal when buying a call option is to sell the call option at a later date for a higher price. So just like when you're investing in a share of stock, you're adopting a buy low, sell high mentality, where your goal when buying a share of stock is to sell it at a later date for a higher price, therefore realizing a gain on your purchase into the shares of stock. It's the same thing with options, and when you're buying a call option, you want to see the call option's value increase in the future, and therefore you will have the opportunity to sell that call option at a higher price, and therefore you will realize the profit on that transaction. Knowing what we just discussed about a call option's value being directly tied to its strike price and where that strike price is relative to the stock price, since a call option's value is tied to its ability to purchase shares of stock at the call option strike price as opposed to the current share price, it makes sense then that when you buy a call option, you want the stock price to increase as far as possible above that call option strike price, as that call option will become more and more valuable as the share price increases, because the benefit of buying shares at the call option strike price that you own becomes more and more valuable as the share price gets to a higher price relative to the call option's strike price. A lot of prices there, I know. Bear with me. So getting back to our examples, if I buy a call option on Apple with a strike price of $200 and Apple is currently trading for $220, I know that call option is going to be worth at least $20, since the call option strike price is exactly $20 below the current share price of $220. If that call option is worth at least $20, we know that that actual valuation comes out to $2,000 when we multiply it by the option contract multiplier. Now let's say a few weeks pass and Apple's stock price increases to $240. Knowing what we know about call options, since the call option strike price is $200 and Apple stock price is now $240, which is $40 above the strike price of $200, we know that that 200 call option is now going to be worth at least $40, or having a valuation of $4,000 when we account for the option contract multiplier. And if I calculate the profit on that trade, if I purchased the call option when it was $20, I had to pay $2,000 for that call option. If Apple's stock price increases to $240, my 200 call option is worth at least $40 now, and when we multiply by the option contract multiplier of 100, we get a valuation on that option of $4,000. So if I bought the option for $2,000 and it increased to $4,000 through Apple's stock price increase, I could go ahead and sell that call option for $4,000, realizing a $2,000 gain on a $2,000 investment, which would be a 100% return on the money that I put into that call option. Because of the immense reward potential and limited risk, buying call options is a very attractive strategy in terms of risk to reward. So now we have to shift gears and talk about how call option buyers actually lose money, since that's the more likely scenario that you're going to encounter when you purchase call options. We just discussed how a call option's value will increase as the stock price continues to increase further and further above the call option strike price, because the benefit of buying shares of stock at the call option strike price as opposed to the current market price of the shares gets more and more valuable as the stock price increases. Now, with that being said, it makes sense then that a call option's value will decrease if the stock price also decreases, because if the stock price decreases, that call option has less value because there's less benefit in buying shares of stock at the call option strike price, since the share price has just decreased from where it used to be, and therefore there's less of a benefit of using that call option to buy shares of stock, since the share price is now closer to that call option strike price. To demonstrate what I mean by this, let's say I own a call option on Apple with a strike price of $175, and Apple is at $200 per share. Based on this, we know that this $175 call option has to be worth at least $25 or $2,500 when we account for the option contract multiplier, and that's because the share price is $25 above that call option strike price of $175. Now let's say, unfortunately, Apple's share price decreases, and a few weeks later, Apple's share price is now at $180. Since I own the call option with a strike price of $175, since Apple's share price is $180, this call option only has to be worth $5, and since it used to be worth $25 or $2,500 in actual value, but now the share price is now lower and closer to the call option strike price, and the call option's value is now only $5, I have lost $2,000 on this call option trade. So with this being said, the most straightforward way that you can lose money when buying a call option is to see the share price decrease after you've purchased the call option. If you buy a call option and the share price decreases, that call option becomes less valuable, because if the stock price is above the call strike price and the share price decreases, the benefit of using that call option to purchase shares at the strike price as opposed to the market price of the shares has now decreased, because the share price is at a smaller premium to the strike price relative to what it used to be. The second way a call option buyer can lose money is through the decrease in the option's extrinsic value as time passes, which is referred to as time decay or extrinsic value decay. So I already explained to you what intrinsic value is for call options, but let me explain what extrinsic value is. If we go back to the Apple call option example from earlier, I mentioned that the 200 call option expiring in 63 days was trading for $13.50. However, Apple's stock price at that time was only $206.10, which means that 200 call option on Apple only had $6.10 of intrinsic value. However, we can see that the option was trading for $13.50. So what is the additional value above the intrinsic value? Well, an option's value above its intrinsic value is referred to as extrinsic value or time value. This is critically important to understand because at an option's expiration date, the option will only be worth the amount of its intrinsic value, if any. As time passes and as an option approaches its expiration date, the option's extrinsic value will slowly wither away, leaving only the option's intrinsic value, if any, at expiration. That means that at expiration in 63 days, if Apple is still at $206.10, the 200 call option will only be worth $6.10, because with the stock price at $206.10 and the strike price being $200, the 200 call option only has $6.10 of intrinsic value. And with the option price currently being $13.50 with 63 days to expiration, if we were to plot the option price over time and assuming that Apple stayed right at $206.10, that $13.50 call option would slowly decrease to a $6.10 call option at expiration in 63 days, since that call option only has $6.10 of intrinsic value. If I bought this call option for $13.50 and it expired with a value of $6.10, assuming I sold the option before it expired and I sold the option for $6.10, I would have a loss of $7.40 on that option transaction, and that means if I account for the option contract multiplier of 100, my loss would be $740 for every call option that I purchased for $13.50 and sold for $6.10. You might be wondering why an option would have extrinsic value, or why the option would be worth more than its intrinsic value, or the value associated with buying shares of stock at the strike price relative to the current share price. And the answer is that extrinsic value is usually referred to as time value, and it's referred to as time value because extrinsic value can be interpreted as the value of an option contract that is associated with it becoming more valuable before it reaches expiration. So in the case of this 200 call option on Apple that has 63 days left until expiration, there are 63 days left for Apple's stock price to increase significantly, and therefore the call option would become much more valuable than it is now, with the stock price only at $206.10. So options with more time until expiration will trade with lots of extrinsic or time value because there's lots more time left for the stock price to increase in the favor of that call option, and therefore there's lots of time left for that call option to become immensely more valuable. And that is why if you look at an option with lots of time until expiration, it will be trading with lots of extrinsic value relative to an option at the same exact strike price that has maybe just a day or a couple weeks until expiration. What this means for you as an option buyer is that when you buy an option, since you have a limited amount of time before the option expires, and as the option approaches its expiration date, the extrinsic value will come out of that option. When you buy an option, you need to be correct about the direction of the stock price movement, and you also need to be correct about the timing that that stock price movement occurs in. Otherwise, your position will lose money from the decrease in extrinsic value as time passes. So instead of continuing to talk about the theory, let me go ahead and show you some actual historical call option purchases, and I'm going to plot the performance and the price of those call options relative to changes in the stock price so that you can see exactly how the call option trade performed as the stock price changed and as time passed. In this first example, a call option with a strike price of $105 and 31 days to expiration is purchased for $3.40. That means the maximum loss potential of this call option purchase is $340 per contract that is purchased, since we discussed earlier that if a contract is quoted at $3.40, we have to multiply that option value by the option contract multiplier of 100 to get its actual value of $340. The break-even price of this call option purchase is $108.40, and I arrive at that break-even price by adding the premium that I paid for the call option, which is $3.40, to the strike price of $105. If I add $105 and $3.40, I get a break-even price on this call option purchase of $108.40. That means that at expiration, if the stock price is exactly at $108.40, we know that this call option will be trading with $3.40 of intrinsic value, and we also know that at expiration, an option will only consist of intrinsic value, and therefore, if the stock price in this case is right at $108.40 at expiration, the 105 call option will be worth $3.40, and since that's the exact same price I paid for this option, I will not have a profit or loss on this trade if the stock price is exactly at $108.40 at the time of expiration in 31 days. Early on in this trade, we can see that the stock price increases very quickly to a price of about $108, and with the quick increase in the stock price right after purchasing this 105 call option, we can see that the value of the 105 call option also increases to a price of about $5. At an option price of $5, if a trader purchased this call option initially for $3.40, they would have an unrealized profit of $160 per call option that they purchased, since they initially paid $340 for the option, but with the option price now at $5, that means the option's value is $500, and if an option goes from $340 in value to $500 in value, that means the option price has increased by $160. At this time in the trade, if the trader wanted to exit this position for a profit of $160, all they would have to do is sell the call option for its current market price of $5, and by doing so, they would realize the profit of $160 per call contract. But of course, there's no knowing when the stock price is going to decrease, and in this instance, let's say the trader thought the stock price was going to continue to increase, so they stayed in the trade. Unfortunately, we can see that the stock price hovered around the strike price of $105 for the entire duration of the trade, and at expiration, the stock price was actually below the called strike price of $105, at which point the option had no value at all, because at expiration, if the call option strike price is above the current share price, that means a trader could simply buy shares in the open market at the lower share price, and they don't need to buy shares of stock at the call option strike price, which means the call option has no value at all at expiration because it has no intrinsic value. This example illustrates time decay very nicely because, as we can see here, as the stock price is remaining near the call option strike price as time passes, and as the option gets closer to its expiration date, we can see that the call option's value steadily loses value as it becomes more and more certain that the option will not be immensely valuable before it expires, because as time passes without an increase in the stock price has less time to increase in favor of the call option, and that means there's a lower probability that this call option will be significantly more valuable than it is now before it expires. Let's go ahead and look at another example, but this time we're going to look at a call option purchase that makes a lot of money. In this example, a call option with a strike price of $92.50 and 42 days to expiration is purchased for a price of $4.65, which gives this trade a break-even price of $97.15. As we can see here, the stock price increases steadily over the entire trade duration and is well above the break-even price of $97.15 at the time of expiration. At expiration, the stock price is around $106, which means the $92.50 call option has about $13.50 of intrinsic value. Now that's because at $106, the $92.50 call option has the ability to purchase 100 shares of stock at $92.50, which is exactly $13.50 lower than the current share price of $106. Because of that, at expiration, this call option is trading with a value of around $13.50, which we know, when we account for the option contract multiplier of 100, gives us an actual call option value of $1,350. With an initial purchase price of $4.65 and the option price increasing to $13.50 by expiration, the profit on this trade would be $885 for every call option that was purchased for $4.65 and sold for $13.50 at expiration. An $885 gain on a $465 initial investment means that the trade in this example had a return of 190% on the initial amount invested into this call option. This example beautifully demonstrates why buying call options is such an attractive strategy, as if the stock price increases steadily over the duration of the trade, the call option purchase can make lots of money relative to what was invested, and in this example, the call option purchase made 190% relative to the amount that was initially invested into the option at the beginning of the trade. Now, on the other hand, if the stock price were to have fallen, the maximum loss potential of this trade is $465 for every call option that is purchased, since if a trader buys a call option for $4.65, that means they actually paid $465 for that option, and therefore the maximum loss potential is $465. So in this case, the ability to make $885 relative to the maximum loss potential of $465 shows why buying call options is such an attractive strategy in terms of the potential risk and potential reward. Now, as I promised earlier, I'm going to actually show you what it looks like when you buy a call option using real brokerage software. And for this, I'm going to hop onto the tastyworks brokerage platform, and I'm going to show you what it actually looks like to go through the motions and purchase a call option. And I'm also going to show you how the options are quoted and how that translates to an actual dollar amount or cost for entering a call option purchase. Be sure to check the link down in the description to learn more about Tastyworks and their commission rates, and to learn about our standing offer of providing you access to one of our paid options trading courses when you open and fund your first tastyworks brokerage account and you use the project option referral code when you open your account. If you've been watching my videos and you enjoy my channel, opening an account with tastyworks and using the referral code is a great way to say thank you, as it helps support me and the channel. Alright, so I've just opened up the tastyworks trading platform, and really quickly, if you're unfamiliar with tastyworks, on the left hand side I have a watch list which just shows some of the symbols and stocks that I'm watching on a daily basis, and this is a pretty short list because I don't watch too many things. On the top left here we have this search box, and right now I've entered Apple into the search box, and Apple's ticker symbol is AAPL, and with Apple's information entered, all of this information is related to Apple's stock. So we can see that Apple is currently trading for $256.51, and I've currently got open the chart tab to show Apple's recent stock price movements so we can visualize what's been going on. So as we can see here, Apple has been on a significant rally over the past few months, and let's say I wanted to play into this momentum and put on a bullish position in an option, and therefore one of the things I might look at is buying a call option. To go ahead and look at what I can do, I have to first go to the Trade tab, and the Trade tab can be accessed by clicking right here on this Trade tab, and once I do that, this opens up the option chain for Apple, and right now I can see all of the different expiration cycles that I can choose from, and in the middle where it says strike, this is actually the number of days until each of these expirations has before they expire. So 44D means that it has 44 days until expiration. I'm going to go ahead and open up the January 2020 options with 72 days until expiration. So all I have to do is click on January 2020, and this will drop down the options in the January expiration cycle, and all of these call options and put options have 72 days until expiration. On the left hand side we have the call options, and we can see we have a bid price and we have an asking price. If you're unfamiliar with the bid price and the ask price, the bid price is the highest price someone is willing to pay for that option, and the asking price is the lowest price someone is willing to accept for selling that option. So in this example, I'm going to go ahead and look at the 250 strike price call option. As we can see here, the bid price is $13.05 and the asking price is $13.20, which gives us a mid price, or a midpoint between these two prices, of $13.15 currently. So if I want to buy this 250 call option, I am going to click on the asking price, since the asking price is the lowest price someone is willing to accept for selling that option, and on a trading platform, particularly tastyworks, to initiate a purchase order, you're going to click on the asking price of that option. And I can see that this is queuing up in order to buy this option based on the green box that has been placed around the strike price and call option, and on the left hand side it says B1. This is telling me I'm trying to buy one contract of this call option. On the bottom here we have this price indicator, and I can go ahead and change my order price with these arrows, and I'm not going to be able to choose necessarily whatever price I want because I have to operate within this bid and ask price. And typically you want to try to purchase or sell an option at the mid price, and if you can't get filled, then you adjust your price slightly out of your favor. So for buying an option, if I can't get filled at the mid price, which is currently $13.15, then I would have to try and buy this option for slightly more than $13.15, and I would have to just keep adjusting the order from there until I got filled. So as I mentioned earlier in this video, this option is being quoted at around $13.15, and that means I actually need 100 times that to purchase this option. So if we go to the maximum loss right here, we can see that the maximum loss, if I purchase this option for $13.15, is a maximum loss of $1,315. Now that's because if I purchase this option for $13.15, I actually need 100 times that to purchase the option, and my maximum loss when purchasing an option is whatever I pay for that option. So if I go ahead and click review and send, this will show me additional information and will allow me to review everything before I actually execute the order and try to get filled. So as we can see here, I'm trying to buy this option for $13.15, and the estimated trade cost is shown as $1,315. Now that's a debit, or DB, which means I am paying to enter this position. If we add the commissions and the estimated fees, then I get a total trade cost of $1,316.14, and that is how much money I need in my account to actually execute this order. So I'm going to go ahead and actually try to buy this call option for $13.15, and since that's actually a little higher than the mid price in this particular moment, I'm assuming that I'm going to get filled instantaneously on this order. So let's go ahead and see what happens. So I was not filled immediately, and that's because right when I did that, well, actually, there we go. So I just got filled at $13.15, and now I own a 250 call option in Apple that expires in 72 days. So to actually go and see that position, I just go to the Positions tab, and we can see that I have a position in Apple, and I can just click on Apple to drop that down, and this shows me that I own one call option expiring in January, and that has 72 days until expiration. The strike price is $250, and this says C, which indicates that this is a call option that I am trading. So we can see the trade price is a negative $13.15, and that means that I paid $13.15 to enter this position. The mark, or the current marked price of this option, is $13.10 in this current moment, and therefore it's giving me an open P&L of a loss of a few dollars. So basically the difference between the trade price and the mark price is showing me that I have currently lost $3 on this position, now $5, because the mark is a little bit lower than what I paid for the option. If the option price increased from my trade price, this P&L open would be a positive number, because the P&L open is just showing me how much money I have made or lost on this position since opening the trade, hence P&L open. So I'm going to go ahead and close this position just to show you how easy it is to close an option trade. And you might already be wondering, and it's a very common question I get, because this option has 72 days until expiration, do I have to hold the position for 72 days until it expires? The answer is no. I can close this position whenever I want, and all I have to do, since I entered this trade by purchasing the option, I just have to sell this option at whatever price I can get, and I will lock in the current profit or loss based on that price. So once I've clicked on this option and it is highlighted, I can right click it, go to close position, and this queues up an order to potentially sell this call option. And I know it's a sell order because it placed a red box that says S1 around the 250 strike price and call option. So this is just telling me that I'm trying to sell one of these call options, but I have not executed the order yet because I need to select my price and then review and send the order, and then finally confirm all the details and send it to the exchanges to see if I can get filled. So I'm going to go ahead and try to sell this for $13.10 since the bid price is $13.05 and the asking price is $13.15. So I'm going to go ahead and review and send. My price of $13.10 is selected, and I'm going to go ahead and click send order. So I got filled instantaneously, and therefore I lost $5 on this trade because I initially purchased the option for $13.15, which means I paid $1,315 for the option, but I just sold it for $13.10, which means I received $1,310 for selling the option, and the difference between those two prices was a $5 loss. So hopefully this was helpful in demonstrating to you how easy it is to go ahead and purchase a call option, and more importantly, how easy it is to close an option position that you've entered. So now that we've talked about buying call options and I've shown you what it looks like to actually make a call option purchase using the tastyworks brokerage software, let's switch gears completely and talk about selling call options as a trading strategy. When selling or shorting call options, you adopt a sell high, buy low mentality. Now because of that, when you short call options, you want the stock price to decrease, because if the stock price decreases, the value of the call option that you've shorted will decrease as well, and that will give you an unrealized profit, since if you sell a call option here and the call option's price falls to here, you will have an unrealized gain on that trade, at which point you can buy back the call option, closing the position and realizing the gain that you have at that moment. Let's go ahead and look at some actual trade examples from history and see how selling call options works as a trading strategy and how it makes and loses money. In this first example, a trader shorts a call option with a strike price of $105, 31 days to expiration, and they sell this call option for $3.40. This gives the short call trader a break-even price of $108.40, because if the stock price is right at $108.40 at expiration, the option price with a strike price of $105 will be worth $3.40, and if I short a call option for $3.40 and it is worth $3.40 at expiration, I will not have a profit or loss on that trade, which means I break even. If the stock price is less than $108.40 at expiration, the 105 call will be less than $3.40, and that means as a short call trader who wants the option price to decrease, I will have a profit on my trade if the stock price is at any price below $108.40 at expiration in 31 days. In this example, the stock price never increases too significantly and actually trades around the strike price of $105 for almost the entire trade duration. And as we can see, since the stock price was not increasing significantly as time passed, the extrinsic value slowly came out of that 105 call option, and at expiration, with the stock price below the strike price of $105, the 105 call option expired worthless, which means as a short call trader, if I sell a call option for $3.40 and it expires with a value of $0, I keep the $340 premium that I make from that transaction, since if I sell something for $3.40 and I buy it back for $0 or it expires with a value of $0, I will make $3.40 on that option trade, and when I multiply that by the option contract multiplier of 100, I get a profit on the trade of $340 for every call option that I shorted. Selling call options is a very high probability strategy because, as we've discussed in this video, as long as the stock price is not increasing with the passage of time, the call option's value will slowly decrease as the extrinsic value comes out of that option. In theory, when selling call options, the probability of making money is greater than 50%, but we need to keep in mind that the high probability of making money is due to the fact that when you sell call options, you have limited profit potential because the option price can only go to $0, which means your maximum profit potential is the difference between your sale price and $0. But since there's no limit to how much a stock's price can increase, there's also no limit to how much that call options price can increase, and therefore when you're selling call options as a strategy, you have unlimited loss potential in theory. Because of that, you're going to have a significant margin requirement, meaning that in the example of selling this 105 call option for $3.40, it's likely that I'll have to put up a few $1,000s in margin to open that position because of the fact that there is such immense loss potential if the stock price were to increase significantly. To demonstrate exactly what I mean by this, let's look at an example of a short call trade that ends disastrously as the stock price increased significantly. In this example, a call option with a strike price of $60 and 43 days to expiration is shorted for $2.28, which gives this trade a break-even price of $62.28. Since this call option is sold for $2.28, the maximum profit on this trade is $228, since if the option is sold for $2.28 and the option price goes to $0 or the option expires worthless, the profit on that trade will be $228. As I discussed earlier, selling a call option all by itself has unlimited loss potential in theory, so there is no way to calculate a maximum loss potential for this particular trade. Unfortunately, the stock price in this example gapped significantly higher on one of the trading days and was about $30 above the call option strike price at the time of expiration. Knowing what we know about call options, if the stock price is $30 above the call option strike price, the call option is going to be worth at least $30. With an initial sale price of $2.28, an increase in the call option's value to $30 represents a loss of $2,772 for every single call option that was sold for $2.28 and later closed for $30. The fact that this trade lost almost $3,000 per call contract, but only had a maximum profit potential of $228 per call contract sold, illustrates why selling call options all by themselves is an immensely risky strategy that I personally would never recommend, especially if you're just getting into options trading. Really quickly, I'm going to use the tastyworks trading platform to show you what it looks like to go through the motions and short a call option, and also show you what the margin requirement would be for the call option that I'm going to sell in this example. Alright, so as promised, now I'm going to show you what it looks like to go ahead and sell a call option as an opening trade. So in other words, shorting a call option. So this is confusing for most because you wonder how you can sell something without initially owning it first, but in trading that is called shorting. So just like buying a share of stock and trying to sell it at a higher price, you can actually do the opposite and you can short a share of stock with the intention of buying back or closing that share position at a lower price, therefore pocketing the difference. So instead of buying low and trying to sell high, you can sell high and ideally buy lower. So with options, that is called shorting an option, and you can do so by initiating a sell order on an option that you do not already own. So right now I'm looking at SPY, which is the S&P 500 ETF, and currently SPY is trading just under $307. We can see that the S&P 500 has rallied pretty significantly recently, and let's say I am a bearish trader who thinks that the stock market is going to decrease in the near future, and I want to take advantage of that by selling a call option. So one thing I'm going to look at is selling this 310 call option. So right now SPY is at 307, but I can sell a call option with a strike price above the current stock market or above the current price of SPY, and by doing so I will sell a call option that consists of 100% extrinsic value. And as we discussed earlier, as time passes, extrinsic value comes out of an option, and at expiration, as long as SPY is below $310, that call that I sold with a strike price of $310 will expire worthless, and I will keep the maximum profit potential. So to go ahead and look at what these options are actually trading for, I'm going to yet again go back to the trade tab by clicking on this trade tab right here, and this will bring up the option chain for SPY, since I have SPY entered into this search box, which means all of the information on the platform will be showing me the information related to SPY. So I'm going to go ahead and look at the December 2019 options with 44 days until expiration. So I'm going to click on this expiration, which will show me the options, and on the left hand side we have the call options, and in the middle here we have the strike prices. So I mentioned I was going to look at selling the 310 call option. So earlier I mentioned that the bid price is the highest price someone is willing to pay for an option, and the asking price is the lowest price someone is willing to accept for selling an option. So when you want to initiate a sell order to sell an option, you're going to click on the bid price. So if I click on the bid price of the 310 call option, that is going to queue up a sell order to potentially sell this call option. And I know that because it puts a red box around the 310 call option, and it says S1, which means I'm trying to potentially sell one contract of this call option. We can see that the bid price is $3.45 and the asking price is $3.47, but as I said earlier, these prices are going to change as the stock price changes and as the market demand and supply for these options also changes. So these prices are going to bounce around, but I'm going to actually try to enter an order based on whatever I'm seeing. So right now, if I tried to sell this option for $3.46, the first thing I want to mention is that knowing that we have to multiply this quoted price by 100 to get the option's actual value, if I take this $3.46 option price and multiply that by 100, I get $346. Right here under maximum profit potential, it shows 347, and that's because the price just changed to $3.47. But if I sell this option for $3.47 and it goes to $0, I will have a $3.47 profit on this option trade since I sold it for $3.47, and if it expires worthless, then I will keep the entire premium that I sold the option for initially. So if I sell this option for $3.47, I am actually going to collect $347 in premium because we have to account for the option contract multiplier of 100 that I discussed earlier. So if I click review and send, we can see that it gives me the estimated trade cost of $347, and there's a green CR next to this, which means credit, and that means that I'm going to collect $347 in my account for selling this option for $347. If we add the commissions and the estimated fees, the net credit that I receive is $345.85. So if I sell this option after commissions and fees, I will collect $345.85 into my account. Now at a later date, if I buy back this option for a lower price, let's say I buy it back for $2, meaning I would have to pay $200 in premium to close this option. My profit on this trade will be the difference between what I collected for it initially and what I paid for it to close the trade. And if this option actually expires worthless, then my closing price would be $0, in which case my profit on this trade would be the full $345.85 that I'm going to collect when entering this trade right now. The estimated buying power effect is something that I mentioned earlier, and this is the margin requirement. So this is the amount of money I have to put up in my account to actually enter this trade. Now I mentioned selling call options is a highly risky strategy because if you sell a call option, there is theoretically no limit to how much the stock price can increase, which means selling a call option all by itself has, in theory, unlimited loss potential, which means I'm going to have to put up a significant margin requirement to account for the potential losses that I could encounter should this stock price increase substantially. So in this case, the estimated buying power effect is just under $6,000. Now that means for me to sell this call option, just one contract of it, and collect $345.85, I need to have $6,000 in available margin in my account to actually sell this option. So that means I would have to have $6,000 of available cash in my account to actually sell this option. So let's say everything looks good and I want to go ahead and sell this option for $3.45. Since that's the actual bid price, well actually now it's the asking price, let's go ahead and see if I can get filled at $3.45. It might take a second, but I'm going to hit review and then send order. And I was filled instantaneously. And to go ahead and confirm this, we can see that there's a -1 around the bid price for this 310 call option. And that is the platform's way of saying that I have a position and I sold one contract of this 310 call option. And I can go ahead and go back to my positions tab, open up the SPY option, and this shows me that I have sold one 310 call option in SPY with an expiration 44 days away, and that is the December 2019 expiration cycle. So we can see that the trade price is $3.45, which means I sold this position for $3.45. And currently we can see my P&L open is $0, actually now -$1 because I sold this position for $3.45, but the current market price of the option is $3.46, which is $1 higher than I sold the option for initially. So this P&L open is just showing me how much money I've made or lost since opening this short call position. So now I want to go ahead and actually close this position because I do not want to hold it. So I'm going to go ahead and click on this option, right click, hit close position, and this is going to queue up an order to purchase this 310 call option, which is the exact opposite thing I did to get into this trade, and that is how you close any option position. You just have to enter the exact opposite trade that you used when entering the position in the first place. So right now I'm going to go ahead and look at the prices. The bid price is $3.46, the asking price is $3.47. If I try to buy this call option for $3.47, I will be filled immediately, but I'm going to go ahead and try to buy it at $3.46 just so I can only lose $1 on this trade as opposed to $2. So actually it's changed now. So if I buy this option for $3.46, I will realize a $1 loss, and I'm going to actually try to get out at $3.45. So I'm going to review and send order, and I'm not getting filled yet because the bid price is $3.45, and typically if you're buying an option, you will not be able to buy right at the bid price. I will get filled, however, if I change it to $3.46, which I can do by going back to the positions tab, right-clicking on my working order, hit replace order, increase the price to $3.46, hit review and send order. But yet again, the price has increased again, and now the bid price is $346 and the asking price is $348. So I'm not going to get filled in this trade just yet. So I'm going to do that one more time and change it to $347, see if I can get filled. And I'm not yet filled because this price is steadily increasing incrementally against me. So it's making it hard for me to get filled on this trade. So I'm going to do that one more time. Go to 348, hit review and send order. And now I've gotten out of that trade because that was the asking price. And when you try to buy an option, you will typically always be able to get into that trade if you buy right at the asking price. But it's advisable to start at the mid price and then work slowly out of your favor so that you can get the best possible price for you. But since in this video I was just trying to demonstrate how easy it is to get in and out of an option trade, I'm not really too concerned about the small loss that I took on this because I wanted to demonstrate to you guys how easy it is to enter an option trade and then get out of that option trade despite having been in the trade for only a couple minutes. So I hope this was helpful. As an alternative to buying call options by themselves or selling call options by themselves, traders will either buy a call spread or sell a call spread, which will help with some of the downsides that I've discussed in this video related to buying call options by themselves or selling call options by themselves. But I'm not going to explain the spread strategies in this video, as I've created entirely specific videos for buying call spreads and selling call spreads. So if you want to learn about those spread strategies, be sure to check the links down in the description so you can watch those videos on each of those respective option strategies. If you enjoyed this video, I would greatly appreciate if you gave it a like and if you shared it with somebody that you think would benefit from the content that I've discussed in this video. I'd also love to hear your thoughts on this video, so be sure to leave me a comment down below and I will respond to you as soon as I can. My name is Chris from Project Option, and I will see you in the next one.